Thank you for being with us today. My name is Laurent Pacheco. I'm the chairman of the London VC Network, so even more so pleased to have you here in this beautiful venue. I also run IFOA, the International Family Office Alliance for Health, a community of family offices, as the name says, who have an interest in investing in healthcare. If some of you are families with this interest, feel free to join us. Our topic today is assessing pitches from the perspective of family offices. I want to make clear, this is VCs pitching family offices, not companies, right? In case you are, so there is no mismatch. We will be discussing how family offices assess GPs, venture capitalists, when they want to raise from them. So I have a great panel today. Simon, Neetu, Myles, Alex. We'll go for a round of intro, please. Simon.
Hi, good afternoon. Hopefully the microphone is working. I don't usually need them because I tend to be very loud, but I'm Simon Foster. It is my pleasure to be the CEO of the TY Danjuma family office. We are a UK-based family office representing a prominent Nigerian family. By background as well, I'm pretty much a dyed-in-the-wool family office guy, and I've run 3 family offices from London, Spain, and Bermuda over the last 30 years or so. Thank you.
Hello, everyone. I'm Neetu, and I'm on the investment and strategy team at Cooper Family Office. We invest in alternatives, funds, as well as co-investments and occasional directs as well. We are split between the public and private side, non-private. My background being VC, I'm trying to drive more capital towards venture capital growth equity. We're an American family office, but we have set up an office in London and hoping to do more allocation to the Europe and UK.
Brilliant. Thank you, everybody, for coming. So my name is Myles. I'm from Alston Investments. It's my own family office. We spin out our own investment holding companies. So we've got a private equity firm, a venture capital firm, and then we've also got a import-export business. And I did my thesis on succession planning within family offices. So obviously applied it to our own firm, but also very excited to add value back to the wider community.
Hi everyone, my name is Alex Fink. I am second generation for our family office, the Fink family office. Our background is in hedge funds, and we're also a political family. My dad sits in the House of Lords, so as family offices go, we're a little bit more open probably than other family offices are. I mainly look after the early stage venture side of what we do, and we both do directs and funds predominantly in the UK.
Very good, thank you all. Before we dive into discussing pitches, I want to discuss family offices as a specific segment of LPs. Some of you may be emerging managers, may not know so much about this segment. So could we discuss some of the specific milestones maybe or questions that family office have throughout their life cycle? And I know you mentioned Myles, right? Your thesis, succession planning is one of them, but can you tell us what's specific there?
Yeah, brilliant. Just show of hands, who is a GP here? Okay, brilliant. Well, so this is specifically for you guys out there. It's obviously not easy to raise capital, it never really is. But there's one trick about family offices, especially within the succession planning, is that there's a current gen and next gen, and it's very important to understand the difference between the two. So current gen is, depending on the stage of their life cycle, it's very important that there's a difference between wealth preservation and wealth creation. And depending on next gen, from our observations, specifically internally in our own family office, we're a lot more long-term and a lot more high risk. So if there is a next gen working themselves into the business, it's good to understand that dynamic is a little bit more risk tolerant. So especially if you're emerging or are more on the high risk side, so venture capital specifically, that would be a lot more appropriate. And you spoke about it, and there are several family offices that we engage with who do have the next generation coming through in their mid to late 20s, early 30s, they're a lot more risk tolerant. So you have all of these different dynamics that are working within family offices and that's just one example, that it's quite important to understand. Because remember, I think one of the important things to note is that a family office, in most instances, specifically for us, is a governance layer. And that governance layer has its own way, a family charter is a good example of what a governance layer is. And I try to understand those dynamics. So generally, there's a bit of a mismatch what's written on the website and also what's happening within the family itself. So it's pretty good to just try and, if you are able to, and if you're speaking to one of the family members, which is ideal, to really understand what the dynamics are, and because there's generally the website and then what actually happens in practice. So I don't know if that helps to answer your question.
Absolutely. Panelists, do you have other comments on that? What's happening behind the doors and what may be important for GPs?
Yeah, I'd add to your point that, second generation have more time. So, when you're looking at venture capital, they tend to appreciate the long time horizons, while generally the principals slightly older and more about tax planning and succession planning rather than getting into a long-term illiquid investment is just not right for them.
If I can carry on from that, I think we follow much of the same dynamics. I think one of the most important pieces about family office is scale and diversity. I mean, if you look at us, we are something like 35 operating businesses in West Africa. We're something like 75 properties in UK, US, Singapore, and Spain across the globe. We run our own liquid wealth fund, and we do a bit of venture on the side as well. And, it's kind of interesting how life changes. My boss is 86. He considers himself a West African oil and gas man. However, his children were educated here. Unfortunately, they support Arsenal. And, they get deeply excited about things that their father simply does not. We do venture, we do philanthropy much more with them. And we find ourselves rolling up sort of the risk curve because of that. And I think, our venture campaign has been going for us for about 5 years now. And I agree with you completely. We're very much next generation of the family driven by that. Because I can't tell you how many times people would come into my office and say, Simon, why aren't we doing venture? Well, we now are. And, changing world. But I think when people are pitching at us, I think people do need to understand it's not the only piece of the universe. I mean, maybe for us, venture is about 5% of capital under management. So we are a deeply idiosyncratic LP when we come to the table.
I think also it's important to know that no two family offices are the same. And something that's also important, kind of like adding on to what everyone has said, is that understanding what sort of education do the family office need to understand venture capital? For example, I'm from California, and there's a lot of California family offices that made their money in tech, they made their money with IPOs, and they intrinsically understand the illiquid issue, they intrinsically understand the startup and scale-up ecosystem. On the flip side, there's a lot of families, and especially some of the families I've met in Europe and the UK, who are from a commodities or real estate background and have no understanding of anything financial markets or tech related. So kind of understanding what sort of education do you need and how much time are you willing to devote to educating the LP or the family office and finding the right family office to fit. And sometimes that means targeting the next gen who are more open to risk.
Very good, thank you. Great introduction to this world. So let's dive into it, right? Into the core. How do you evaluate GP pitches? What criteria you look? How do you prioritize them?
Very interesting. I mean, as said, we are an idiosyncratic LP. And I think everything that we do is relationship driven. I can't tell you how many crypto funds walk in my door. We don't do crypto. And the reason we don't do crypto is I'm getting old and I don't frankly understand it. And we only gravitate towards doing things that we do understand. So for us, when we're evaluating LPs, we're deeply industrial in Africa. So a GP who's got assets that fit with our industrial base is a good fit for us. But we don't work the way people think we do sometimes. I can't tell you how many times people go, here's an Africa fund, you're a natural Africa investor, you should go and invest in that. Really good point, but we're deeply, deeply, deeply overweight on West Africa as it stands right now. So for us, our 8, 9 LP positions are diversified, they're different funds, they're different vintages, but we're concentrating pretty much on UK tech, European tech, and American tech because we think we stand a good chance of understanding that as opposed to crypto, which we don't think we do.
I think for us, we like co-investment. So something that has made us really excited about the UK and European ecosystem is the fact that the valuations here, especially at early, but also even at the Series A, Series B, are lower than what they would be in the US. So good co-investment opportunities is something that we look for when we're evaluating GPs, and also something called GP investment thesis fit, which is basically how are these GPs like the best people to be investing in this particular thesis? What in their personal, professional experience means that they'll be able to find the best deals in this particular niche and be able to support the portfolio, which obviously, as you go earlier and earlier, is more critical because, a pre-seed seed investor will be providing more work with the founder and more support to the founder. We don't want people just chasing trends, right? Like I think there were a couple of funds that used to be Web3 and now they've shifted to a different strategy, or people just tacking AI on their deck, whether they're a founder or a GP. We really want to see that there has been a lot of thought put toward the investment thesis and that it is a long-term plan where they're planning on keeping that thesis for the next subsequent funds as well.
I'm waiting to hear some metrics, numerical expectations, but let's see how we go.
Simon, I thought you were a bit of a crypto bro, but...
I've got some land for you in Lagos, don't worry.
Really, yeah. So I think for us to talk specifically about both of your points, it's relationships are very important, and then also knowledge. Do what you know, do a lot of it, and do it well. And I think if you're trying to diversify too much, you kind of dilute the value that you can add. So specifically for us, we look at, okay, well, is there alignment between the team, and obviously we back ourselves, but is there alignment between the team and what they're trying to do? Because I think if there's a mismatch there, then you are taking a bit of a risk. But if somebody knows what they're doing, then you're kind of hedging your bets a little bit. To answer your point around the more on the financial sense, it's like how quickly is the timeline in line with what we are expecting as a family office? So, we've the previous panel was speaking about DPI. I think there is a big problem with capital inertia being returned back to LPs. And, I think that's stemming back to 2021, 22 when we had the market correction. So I think, those three things really, it's like, is there alignment, relationships, and focus?
So we're quite different in what we look for a family office because we'll be the annoying LP that likes to be quite involved with the fund. So for us, what we care about is that the fund we're investing in cares and is really helpful to the portfolio companies to maximize their chances of success. So with funds that we've invested in, Empirical Ventures that are here, Outward VC that are here, we've done co-investments with them right from the start. We've acted with them on the boards. We've seen how they operate as a VC, how helpful they are to the portfolio companies. And then we go, that's a manager I want to back, the one that actually cares and is really trying to drive value forward, help putting the next rounds together, getting the right people in the room, finding the right partners for that. For their portfolio to really maximize the chance of success. We as a family have no interest in funds that, take active roles, no board seats in the portfolio companies that are passive investors on the cap table. We really want the guys that will make it happen and put in the work. And then the second thing we really look for is we really take thematic views on where we think the world's going, and we're predominantly UK investors, and so we look for sector specialists in specific areas. So, deep tech fund, a fintech fund, and then we'll hopefully be looking at a defense fund this year, and maybe a quantum fund as well. So we kind of try and identify where we think the trends are going and find the right VC that we think is going to work with early stage companies and bring it through that trend.
In these decks you will receive, or in the discussions you'll have with GPs, invariably, if they have the data, you will be presented with the MOIC, past IRR, DPI. So what do you think of those numbers?
Obviously, if you have great performance, it definitely helps. But I think, as I said, for us, it's more about let's do a deal together or find a deal that works. Let's work together first and see that we can get on before, let's date before we get married, I think it is the key. And so that's what we try and do. But, there is always that temptation, and a lot of family office do it, is just back the manager with the best DPI or the best track record. And you often find, especially that happens in the much bigger funds that are doing, much bigger size, much later stage. But the numbers they actually need to hit to return the fund are just huge when you get to raising, massive funds.
We agree. I mean, funnily enough, I saw the last panel. We're talking about people being hesitant to back emerging managers. Indeed, it's idiosyncratic. We actually like emerging managers. We'd rather be an LP with way in a relatively early stage fund so that we have access to the manager, we understand implicitly what's going on, rather than being in a big fund where we don't have that access. And okay, the big funds probably have numbers that are impressive going back in time, but past performance is no guarantee and there's always a leap of faith. So we'd rather do leaps of faith with people we think get it, and as you say, stand a good chance of playing a sector that we have interest for.
We see these days some buzz, some hype around family offices, right? Ventures willing to raise from families, VCs as well, of course. And there is a bit of a sentiment, maybe it's an easier route. So is that true?
Yeah, it's interesting. Back to Neetu's point, every family office is different and they will all have different investment processes. Some may be very, very institutionalized like a VC and go through data rooms and go through everything. Others will just, if you catch my dad on the right day in the right mood, he may just decide to write you a ticket there and then. So it can be very different. We try and formalize it. We try and put the process in. And we try and do co-invest with a lot of the VCs that we invest in as well, because we know that they're doing the heavy lifting on diligence work. And where we have fouled in the past is not doing enough work as a family office. So sometimes you can see it as being easier money or dumber money, because often they rely on whoever the lead is doing all the work and heavy lifting for them, and the investment processes are much quicker. But again, not all family offices are like that, and it depends who you catch and what the appetite is at the time.
Yeah, I think to an extension of that, it is, and we spoke about it earlier, it's about relationships at the end of the day, and our family offices and the ones that we work with who co-invest alongside us in different assets, either as co-investment through our portfolio companies as a family office or with our subsidiaries within the family office. We either go along, and that is very, very relationship based. And generally what happens is that we start somewhere and then we build and we build and we build and we keep buying up within or putting more capital in. So I think what we see is that long-term thinking is say, okay, well, let's get on the journey. And I think the more institutional side does struggle with that a little bit, because they have their structures and this is the process, and we've got, please don't step outside the process, and they've got, it's just a little bit more complicated. Whereas I think, like you said, you catch your dad on the right day, he's kind of a little bit more flexible, and I think that's very much obviously there's investment analysts and whatnot, but ultimately someone can push a decision through if they want to. So, and that relationship is quite important if you understand the dynamics yet again.
So I think basically I've noticed when we were at a lot of LP checks, and I think the advantage of us doing both LP checks and direct investments and co-investments is that sometimes when we have an area or sector that we're particularly keen on, we are able to move extremely quickly. Or for example, when we do go to things like conferences or Super Return, or we just meet people through our network, if someone is able to meet me or the head of our family office, it is easier to convince than, let's say, like an institutional allocator or perhaps a pension fund, which can be notoriously slow. I will say that I have noticed, I know we're talking mainly about LP allocation, but on the direct investment front, I have noticed that there are some founders that assume because we're a family office, we don't diligence. So they'll be like, oh, you like this sector. Let me show you all the companies in this sector. And it's like, we still, even when we do directs or even when we do co-investments, we still diligence. I don't know, I can't speak for every family office, but I think there is that misconception of, oh, if there's a non-traditional, like a non-traditional model for a business, and it doesn't fit into the norms of VC or angels, a family office will just sign off on it. And sometimes that works, but sometimes it doesn't.
Agreed. I mean, we're very much similar. It depends on who's asking when and why. We've been a venture investor, must be 8, 9 years now. And what's good about that is we've got some of our partners who are coming back with new vintages. And, some of the people that we see now, I remember, the first time we did due diligence on them, it was the task of weeks. Looking at their second fund was the task of about 3 minutes flat. We all went in a meeting saying it's these guys, they did well for us in their last vintage. We're happy with the numbers, let's up the ante, and that can happen really fast. So I think it depends on circumstances, but I think the theme that everybody's talking about today is that of relationship, and I think for me, that is the fundamental issue for family offices.
Beyond, again, the track record, these KPIs, we've mentioned the relationship, the human side, right, of the relationship. What are the non-financial attributes you would be looking for? You mentioned, I think, at the beginning, Neetu, the opportunity to co-invest directly. So what are all the benefits you may look for in this relationship?
I think from a GP's perspective, you want to raise as much capital as possible and obviously drive people towards first close. So I think something we've noticed is advantageous terms for LPs if they come in for either the first close or second close. That's something that, obviously we value. I think advantageous terms for participating in co-investments, right? I think that's something that we value as well. Unless we're doing co-investments, we don't typically do that many SPVs with people that aren't in our portfolio. When we do direct investments, it's directly into the company from our network. So I think that's something that we really like as well. And then also being able to pick the co-investments that we want to participate in from the portfolio, being able to follow on for the winners in the fund is something that's important. We don't want to be asked to participate for the struggling companies in the portfolio. We want to be able to participate in the companies that are doing above average and the ones that are clear winners as well. And sometimes that's great because funds might not have an opportunity fund, so then they go out to their LPs to participate or help the portfolio company raise for future rounds, which is nice.
So I think maybe just to bring 2 points together, we spoke a little bit earlier about the relationship side, and I'll be touching on the space of saying, okay, well, how do we create the connection between, in terms of the follow-on? So, is there a value alignment between the GP and the LP? So, for us, if we were to follow on in something or co-invest, we would say, okay, well, as a family, we would want to have quite a high level of transparency into the portfolio company, so reduce the information asymmetry risks. So essentially, coming back to your point, is saying, okay, well, if there's alignment between ourselves and the GP who's able to bring that information into those co-investment opportunities, more than just a board pack or a pitch deck or whatever, but that's, stats, you can, if you're smart enough, you can kind of play with them. You want to remove the noise and really get a true picture. So I think getting it from your GPs or managers that are able to give you a level of transparency that you as an LP do see value in, I think that part is very valuable to the co-investment space as a family.
I think adding on some other points, I think really know your sector, really know your space. As a GP, really know the other investors that will do your next round, right? Or ones that you can syndicate with to make the companies a success in the portfolio. As I said, we're quite difficult LPs, and we want a relationship with the underlying portfolio companies and the founders of that company direct as well. We don't just want to see names on a piece of paper and go, oh, this one's performing. I want to be able to call up my GP, empirical, I can ask Jonathan, which companies are doing well, which ones are not, tell me what's the latest, and then if I want to speak to the portfolio companies, I have the access direct as well to speak to the founder. And I think that's really important. And, when they know better than anyone what their portfolio is doing and they're really in tune with what the latest update is in each one, that's what we care about. What I don't want is a quarterly report just stating numbers and MOIC, but not actually really knowing what's happening underneath the surface, because you can stick those numbers anywhere and it doesn't really kind of tell you what's actually going on with the portfolio.
Yeah, we feel the same way. I mean, you talked about not being a passive investor earlier, and we're deeply non-passive. We feel the same way. We expect to know the GP, we expect to know the underlying companies and how they're working. And I think, relationship keeps coming up and is going to come up again because, in various places with some of the funds we backed, we have representation on the LPAC. That has been helpful to us from an understanding perspective. It's been helpful to us from a deal flow perspective. And, we also like co-investment transactions. If the fund's coming in, if you've done a lot of due diligence on it and you can share it and we can piggyback on that, that's of deep interest to us as well. Something else we haven't mentioned, we also like secondary. So for some of the funds that we have supported, there have been secondary opportunities floating around. And from a liquidity perspective, that's something that we find attractive to be able to mop up on the right terms, of course.
A lot of good tips there. Very good, thank you. So before opening to questions, there is always the final advice to the audience, to GPs. But how about you share with us, if you like, an experience, like a bad experience, as in it didn't impress you so much, this GP with this speech, if you can recall and maybe share with that. It's an add-on question, right? So you may not have at the top of your head. And if not, straight into the advice, it's always valuable, of course.
Okay, I can go first. So we do with Empirical the EIS, EIS allocation, and when we were doing that, we were looking at other managers. I'm not going to name who it is, but he goes, well, I'm managing £30 million SEIS, so 250 grand a company, and there's two of us on the team, so we basically have to get through in a year, 50 odd companies. So how much diligence and how much time and how much monitoring is actually being spent on each of those companies? And I said, that is just not a fund I want to touch at all. It's a spray and pray strategy.
I think certainly from our side, it's, we very entrepreneurial, so we expect our partners to be entrepreneurial as well. So what I mean by that is business doesn't live in a spreadsheet, it lives in the real world. And what we need to see is is the management team able to solve problems? Because that's essentially, I think a lot of factors to a successful business is how quickly management teams can solve problems. And let's call a spade a spade. A fund manager is a business. So are they actually looking at why past businesses didn't work? And are they bringing that into their due diligence or their value add process or whatever? Like, are they innovating? And I think that's quite an important thing that we like to see, is that are they dynamic, or do they get stuck in a process where they're doing 50 deals each a year, which is like a deal every 2.5 days, which is, that's quite a lot. So, I don't know if you can solve problems that quickly and trying to allocate into a deal every 2.5 days.
I think it's really important. This is a case often with some funds in the US, but managers might raise a successful fund one and a successful fund two, and they start to play something called the AUM game, which is, even if they're an early stage pre-seed, seed, sometimes Series A fund, they might overhire analysts and associates, or they might just grow their team, and because of that, they need management fees that covers everyone, and oftentimes they keep increasing the fund size. And what their initial strategies were for their fund one, fund two that were very successful can't be replicated when the fund size has scaled so broadly. So that's something that we try to caution against. Also, I would say liquidity is obviously an issue that a lot of people are concerned about, and I think the IPO market has been struggling a bit. So I think we are interested in secondaries, but also we just look for GPs that have creative solutions and ways to help their portfolio with M&A acquisition. So whether that means that they have been in industry in the past, whether they're a former founder that has, had their own exit, maybe they've been part of an early stage, early growth startup, and they've helped a startup, guide through an exit as well. We really look for that sort of differentiator, because while it would be nice to be like, yes, every company in the portfolio wants to be a unicorn and wants to have an IPO, reality is like that often doesn't happen. Just looking for GPs who are thinking about creative solutions and ways to help the portfolio, and not trying to grow a fund to, necessarily £1 billion if they're a pre-seed or something.
I think there's a big communication issue between VC and family office, though, and I have to say it. I know we all probably live on LinkedIn. I live on LinkedIn. Funnily enough, I got my current job on LinkedIn, and there are databases on LinkedIn which call themselves family office databases. Yeah, great. Family offices don't help themselves because we're quite furtive, we're quite secretive, we're hard to get in touch of, we're hard to get to find, and then when people do find a family office, they get all excited and send you an email, yeah, great, of their Lithuanian property fund, where if you read my website, it would actually tell you the kind of things we're naturally interested in, but you didn't. And the problem with that is, though, if you wanted a bad example, if I pulled out my phone now, I will have something like 10 cold call emails on various pieces of deal flow. And I hate to tell everybody who's in business dev for the funds that for every one of those emails, I will block the sender and delete it. The same databases will also have my personal phone number in it, and I get a number of phone calls on that from people trying to raise funds, and I swear every single one of them and block those numbers as well. So it's kind of the reverse of my comments about relationship. And I think the only way to really interact with family offices is old school relationship management, because if someone I know says, hey, we've got this great fund, we invest in them, or if our bank brings them and says, will you take the meeting? We will under any circumstances. But I think the way the world thinks that biz dev is working with family offices is absolutely wrong. In 30 years in 3 family offices, I have never once responded to any cold call email in any circumstances whatsoever. Yet, if people came in with friends of ours and asked us to come out for coffee, we do that all the time.
Simon, so what you're saying is your LPs are your biggest kind of strength for the GPs?
Yeah.
Biggest advocates for you?
Biggest advocate for it. I mean, a number of the funds we've invested in have brought people in to see us, and that's worked out well. A number of the banks we have transactions with have brought people in, and that has worked out well as well. I just think, cold approaches in this industry, there's no way. I don't know if you feel differently about that.
I think when we're analyzing direct deals, we like to say everyone has a chance, if something really interesting comes through. But obviously, you do get greater weight from if it's a really good investor or a really good family office that are like, you should really have a look at these guys. You will look probably a lot more deeply than the hundreds of emails coming through. But we like to say everyone does have a chance getting through to us. But family offices only have a set amount of capital, same as VC funds, and then what's even harder is, unlike a VC fund, you have to argue, do we allocate to venture this year, or do we put more into public markets, or do we go into property, or we've got to look at loads of other different markets and see how they're performing and weigh that up against our venture allocation each year.
Very good. Thank you, panelists, for such an open, very open discussion. Every family is different. We understand that as well. Opening now to questions. Do we have mics for?
We've got a floating mic here. We've got one at the front. We probably have time for about 2.
Thank you.
Hi, thank you very much, and it's a very interesting discussion. So we don't get to hear a lot of the family offices talking about ventures, so it's great. So I'm Praveen. I'm a former LP investor, and I run a PC advisory now. So how do you see now the venture capital allocation within your asset allocation? So do you see it increasing? Because a lot of the value creation is happening in private markets today. $1 trillion private market valuation is unheard of in the past. Do you see it increasing, and how is the venture performance in your portfolio in general, and what do you forecast for the next years?
So if I go first on that one. So I think since we moved into a slightly higher interest rate and there's been less DPI coming back, I'd say, at the moment, probably the venture allocation's overweight, but will probably come down as DPI starts to happen. And then you've got other attractive opportunities with higher interest rates. A few years ago where it was 0 rates, you were having to do venture because you weren't making the returns anywhere else. So you really needed the venture to kick up your profile of returns.
For me, I see it growing. I mean, this can come as a surprise to many people. We don't want our money back. And for me, the most difficult thing about investing in venture is now you've written me a check, what on earth am I going to do with that? And we are strategic asset allocation driven. Right now, we're about 5% is sitting in VC. That VC has performed extremely well for us. We've done far better than the 15 to 20%, which was proposed at the last panel. One of our partners put us into a very good AI company, which I won't name, and we're getting money back from that. And now we've got the difficult subject of what on earth do we do it? But what's great about that is we're about 8, 9 LP positions positions right now. They're all throwing off cash, and what we're doing is we're recycling that cash into other funds and other vintages. So I see it growing, but I think it growing from the profit component rather than us changing our mind and going, we're going to cut our liquid wealth and move more into VC. But it's been a good path for us, that's for sure.
Thank you. Another question?
So my question is to Alex, probably, but also feel free, everyone else. You always talk about the VCs that care. What are the care signals that you look for?
Yeah, very, very good question. I think, as I said, it helps if you're on the board of a company. So, I've seen I've seen Empirical and Outward put rounds together and making introductions to over 100 VCs for their portfolio company and the tier ones as well, getting them to the right people in the tier ones straight away, because they trust that the deal flow from the GPs we back are the right deals that they want to see. And it's that credibility that these guys are picking the best deals. I want to see them first, and I'm getting into partner level at the next funding round and getting them funded and getting their Series A's away if they're the pre-seed and seed funds. And then on the other side, it's actually, there's a lot of company management. There's a lot of times where, things don't always work out with a co-founder and you've got to have a difficult conversation or you've got to replace the CEO, and the VC fund often has to kind of step in and help make those decisions, help, restructure the board or, put a vote to a board and try and sway the other board members to get on board. And as well, when things are going badly, the VC that will put his hand back in his pocket reluctantly and maybe help out the company or try and find a way to help it out and get it across the line. So those are all the things where I say, care about your portfolio companies.
I think there's also, from a you speak about value creation and value add. I think if specifically talking about the guys that are not generalist, you generally know as a fund manager where the problems are within the portfolio. So it becomes a little bit easier to identify where you can add value as a VC in areas where, in early stage businesses, like everyone knows, it's revenue and growth capital. So how can we move the needle on that side? It's like, that should be one of the questions. Like, okay, how can we add value there? And then also, I'm a big supporter of the carrot and less the stick. So actually getting involved in the businesses and adding value actually gets more. You're able to make more of an impact and have more of an influence within the business without it being explicit. More implicit.
I'll give you another interesting one is, when Silicon Valley Bank collapsed and all our portfolio companies who were banking with them, had to rush round to find new bank accounts, which was a lot of fun and games that weekend to happen on a Friday. The VCs jumped in and really had opened their relationships with their banking managers to get new bank accounts and get the money transferred out into those new bank accounts. So those are the VCs that care, that really I really need to help at this point and step in.
I think also it's not only looking at how they're helping their portfolio, which is super important, but also looking at when they reject founders, how do those founders feel about them as VCs? And I think some of the best VCs we've met, the founders that they pass on speak very highly of them. And even within their portfolio, not only are they helping and supporting the founders the portfolio companies doing really well, but the portfolio companies are struggling, speak highly of them as well. So I think we just love seeing how the portfolio, as well as founders that have passed on, speak on VCs, and that kind of speaks to their reputation and how much they care for both their success stories, but also not their success stories.
I know we're running out of time. I'll be really, really quick. But social conscious is also deeply important to us as well. We were the first family office to sign up to the UN Principles of Responsible Investment. We're not saying that all the funds that we support have to do that, but it's part of the reason why we want an understanding of what the underlying companies and the underlying corporates are to make sure that they fit the ethical standards we impose on ourselves.
Thank you so much for the openness again. I think a lot of advice and great tips, and hopefully to raise a GP generation. Thank you for the question. Hope you have a great day. Thank you, panelists.
Thank you very much.